Why do banks hedge their banking books? Banks play a significant role in the global economy by facilitating financial transactions and providing various financial services. One of the strategies banks employ to manage their risks is through hedging their banking books. In this video, we will explore the reasons why banks hedge and the benefits it brings. What is hedging? Hedging is a risk management technique that banks and other financial institutions use to offset potential losses from adverse market movements. It involves taking positions in different financial instruments to neutralize or reduce the impact of risks on a bank's balance sheet. Reasons banks hedge their banking books. 1. Interest rate risk management. Banks are exposed to interest rate fluctuations, which can impact their profitability. By hedging their banking books, banks can protect themselves against adverse movements in interest rates. They do this by entering into interest rate swaps or futures contracts that offset the risks associated with changes in interest rates. 2. Currency risk management. Banks operate globally, dealing with multiple currencies. Fluctuations in exchange rates can affect the value of a bank's assets and liabilities. To manage this risk, banks hedge their banking books by entering into currency forwards or options contracts. This helps them reduce the volatility associated with currency movements. 3. Credit risk mitigation. Banks face credit risk when borrowers default on their loans or when the creditworthiness of their counterparties deteriorates. To mitigate this risk, banks engage in credit hedging strategies such as credit default swaps or collateralized debt obligations. These instruments provide banks with insurance-like protection against potential credit losses. 4. Liquidity risk management. Maintaining adequate liquidity is crucial for banks to meet their day-to-day obligations. Hedging allows banks to ensure they have sufficient liquidity to cover unexpected events or fulfill their regulatory requirements. Banks may use various instruments such as short-term borrowings, repurchase agreements, or liquidity swaps to manage their liquidity risk effectively. 5. Regulatory compliance. Banks operate within a regulatory framework that imposes certain requirements on risk management and capital adequacy. By hedging their banking books, banks can demonstrate to regulators their ability to manage risks effectively. This helps to ensure compliance with regulatory guidelines and maintain the stability of the financial system. Benefits of hedging for banks. Hedging offers several benefits for banks, including risk reduction. Hedging allows banks to minimize potential losses by offsetting risks with corresponding positions in other financial instruments. Increased stability. By hedging, banks can enhance their stability by reducing the impact of market fluctuations on their balance sheets. Better capital allocation. Effective hedging strategies help banks allocate capital more efficiently, ensuring it is deployed in a manner that maximizes profitability and minimizes risk exposure. Enhanced risk management. Hedging allows banks to have a more proactive approach to risk management, enabling them to identify and address potential risks before they become significant issues. In conclusion, banks hedge their banking books for various reasons, including managing interest rate and currency risk, mitigating credit and liquidity risks, and complying with regulatory requirements. By employing hedging strategies, banks can enhance their stability, reduce potential losses, and demonstrate effective risk management to stakeholders and regulators. Want to learn more? Claire Trithel on LinkedIn.